Hey guys, welcome to this week's episode of the College Investor Video. I am really excited to be here with you today because we are going to talk about 10 ways that you can save on your taxes before the end of the year. Now that sounds a little crazy because it's already like nearing the end of the year. But honestly, there are some choices that you can make right now that could save you on your taxes. And you would be surprised that some of these things are really easy to do and they can save you a lot of money. And so I really want to go through this list of 10 ways that you can save on your taxes. And I want to highlight this and say that honestly, this isn't like Donald Trump style. Like, I'm not talking about losing $10,000 in the next 3 months so that you could write that off on your taxes. I want to show you some genuine ways that you can save on your taxes by making some choices with your finances right now. So let's get started into this and jump right into the first way that you can save on your taxes, and that is boosting your 401k contribution or your 403b contribution if you work at a nonprofit. But contributing to your 401k is a great way to save on your taxes. Honestly, there are you can contribute up to $18,000 if you're under 50 years old, and you can add an additional $6,000 if you're over 50. But the cool thing when you contribute to your 401k is that every dollar you contribute gets deducted from your income, and so you are not paying income tax on the amounts that you contribute to your 401k. So if you still have some ability to contribute, it is a great time to contribute to your 401k and boost that 401k contribution. Along those same lines, we'll get here into number 2. So the number 2 way that you could lower your tax bill before the end of the year is to contribute and max out your traditional IRA. So an IRA is an individual retirement account, and a traditional one uses pre-tax money. Well, in 2016, you can contribute $5,500 to an IRA if you're under age 50, or $6,500 if you're over 50. And the same thing happens. If you contribute to an IRA, you get to deduct that amount from your taxes, and you save on your tax bill. So it is a great way to save some money for yourself and avoid paying taxes this year on that contribution. All right, number 3. Are you a hustler like me? Are you doing a side job? Are you driving for Uber? If you are and you have side income or you work for yourself, you should be maxing out your SEP IRA or solo 401k. So this is different than a traditional IRA. Your SEP IRA is based on your income from your side business, and you can contribute about 20 to 25%. It's a calculation, but you can contribute that money into this IRA, which is saving for yourself for retirement, but it lowers your income on your business, which that saves you a lot of money. So if you are a side hustler and you're concerned about the taxes that you're going to pay, look at maxing out your SEP IRA or opening and trying to put as much as you can into a solo 401k. All right, going to number 4 here. Number 4 is to max out your health savings account, an HSA. This one could be tough for some people because some employers require you to do this when you do open enrollment. But if you're able to, max out your health savings account. You can contribute up to $33.50 if you're a single individual or $67.50 if you're a family. And the cool thing about a health savings account is that it works very much like an IRA, except you're also able to withdraw that money tax-free for medical expenses. So, I recommend that if you're able to, save that money all the way into the future and use it like an IRA, but it's always a tool there, and it reduces your taxable income because this is pre-tax money that goes into this health savings account. Okay, guys, moving on to number 5 here. Number 5 is save for your children's college. Now you notice I put this as number 5 for a reason, because I want you to save for yourself first. You should be doing your own 401k, your own IRAs, and that type of thing before you take care of your children. It's like the airplane example. You need to put the mask on yourself first so that you don't pass out, then you can help your children. I know it sounds counterintuitive, but your kids can get a lot of ways to fund their colleges, but you don't have a choice when it comes to retirement. You can't get student loans for retirement, so you got to take care of yourself first. But if you are taking care of yourself first and you're still looking for ways to save, consider doing a 529 plan. Now, this won't save taxes for everybody because right now there's only about 39 states that allow you to deduct your contributions into, or 32 states, that allow you to deduct your contributions to a 529 plan. But if you live in one of these 32 states and you contribute to your kid's 529 plan, you can actually deduct that amount from your taxes and save on your tax bill. So it's win-win. You get to save for your kids' college and you get to lower your taxable income in 2016. All right, moving on to number 6. Number 6 here is for all the homeowners out there. And this is making energy efficient improvements to your home. So in 2016 right now, this is the last year, unless Congress renews it, that you can get 30% tax credit for installing solar on your house. So if you haven't installed solar yet, you still got 3 months here to do it, but this is the last year that you're able to take that tax credit unless Congress extends it another year. On the same thing, you can get 10% tax credit for doing other energy efficient improvements to your house. For example, replacing windows and doors to be more energy efficient. If you upgrade your air conditioner, you add insulation. Basically, if you're making your home more energy efficient, there's a whole list of things that you can do that will give you a 10% tax credit. Now, I don't advise you going out and spending money just to save on taxes. That doesn't make sense. But if you were already thinking about doing these improvements to your home, now is a great time to just knock them out, get that savings, save on your taxes before the end of the year. Okay, moving on to number 7. Number 7 is maximizing your work-related expense deductions. Woo, that's a mouthful right there. But what it means, guys, is that if you have work-related expenses, you need to be deducting them from your tax return. And the problem is a lot of us are not good at keeping records and keeping track and making sure that we're getting every single dollar that is allowed for us to get legally. We just suck at keeping records. So let's talk about some of these expenses that you can take. You could possibly take transportation and travel. If you have to travel for work, you can get mileage, right? If you have to pay union or professional dues, if you have to buy a uniform and your employer doesn't reimburse you and you can't wear it outside of work, you could deduct that. Work-related educational expenses. This is especially in jobs that require continuing education, which means that you have to have a certification and usually you have to take a class a year or something to maintain that. You can deduct that from your taxes as well. The other thing is if you're like a side hustler, you should be keeping meticulous track of all your expenses because those are just expenses for your side hustle. For example, if you drive for Uber or Lyft, you need to be keeping accurate track of your mileage because you should not only be earning your Uber or Lyft money, but you should also be deducting all the mileage you drive because you are driving for your Uber job. But that's hard, right? Because with Uber or Lyft, you're stopping, you're picking people up, you might forget to keep track, write down the odometer. So we need an easy tool to do it. One of the easiest ways I've found to keep track of your work-related expenses is called Rebalance. So if you drive for your job, Rebalance is an app that runs on your smartphone and you can have it running in the background and it will automatically keep track of all your mileage for you. This is like the greatest app in the world for Uber or Lyft drivers because honestly, you just turn it on, open the app, and you don't have to think about it again. And it's just keeping track of everything in the background for you. And then when you're done for the day, you can go in there and you can decide what was actually work related, not work related. Maybe you drove to get lunch or something, it wasn't work related, but then you started working again. It keeps track of all that for you. So Rebalance is the app. The bigger thing is to save on your taxes, make sure that you are keeping track of all of your work-related expenses because that is huge to save money. Okay, guys, moving on to number 8 here. Number 8 is donate to charity. So if you have, we'll start off here. A great way to save is just simply donating to charity. You can donate cash and you can donate stuff to charity, and you can deduct that from your taxes. So one of the things I advise is doing some fall cleaning right now because you're done with the summer, you're getting back into your routines of work and school. So now is the perfect time to look at things that you haven't, any clothes you haven't worn in a year, any stuff that's sitting in your garage, and donate that stuff to charity, get your receipt, and you can deduct the thrift store value on your tax return. You don't get to deduct what you paid for it. So if you deduct, let's just say you donate your, TV to charity and you paid $200 for that TV. You don't get to deduct $200. You get to deduct whatever the thrift store sells it for. So maybe they sell it for $25, $30. That's what you get to deduct on your taxes. If you donate cash, you get to just deduct what you donate. So really just the big thing is get your receipt. Don't go crazy, guys. I'm not telling you to buy stuff to donate it, but I am saying all of us have stuff in our closet that we haven't worn in a long time. All of us have crap in the garage that honestly is just sitting there collecting dust. Think about it. Do you need it? If not, donate to charity. It goes to a good cause, and you get to deduct it from your taxes and save some money. Okay, number 9. This is for the investors out there. The fall is a great time to look at any loser stocks in your portfolio or loser mutual funds and loser ETFs and to sell them and get rid of them and take those losses. Now, I told you up front, I didn't want you to be like Donald Trump, because Donald Trump, the whole story, he lost $1 billion in real estate and has been not paying taxes for years. Well, the reason is if you lose money on an investment, you can write off future gains from your investment and offset that for a few years. And so when you look at your own portfolio, if you have any loser stocks, now is a great time to look at getting rid of them. Now, you have to make this decision for yourself. Like, I can't tell you if it's down 5% to get rid of it. Maybe it's going to be a long-term investment. You just got in at the wrong time. So really, look at your own asset allocation, look at your own investments, and decide if it's a good time to sell any investments that you have that have been on the losing streak. But you can take that loss on your tax returns, and that will save you a little bit of money. All right, number 10 is kind of part 2 to number 9, but it's important to remember that you need to wait until 2017 to rebalance your portfolio. So if you own mutual funds and ETFs, one thing that happens every single December is that they pay out their capital gains and their dividends. And for some funds, this can be huge money. So, these funds are paying out thousands and thousands of dollars in capital gains and dividends to you. But if you buy right now in November or December, right before you get that distribution, you're honestly just buying a tax burden for yourself. Because these funds you're going to have to buy it, you get this huge dividend, and then you have to pay taxes on it right away. And what you have to realize is that the net asset value, so the value of that investment, it adjusts for the capital gain. So it'll drop, you lose some money, but you get this huge capital gain. You are just buying yourself tax burden. So wait until the new year to rebalance. So November, December is a great time to sell. And then when you're thinking about rebalancing and buying new stuff, wait until January or the new year before you make those new investments so that you're not just buying yourself a tax burden. Sounds a little weird, but trust me on that one. You're going to buy yourself a tax burden if you don't do it. All right, I want to leave you with a final thought here because we didn't touch on a few things because some of them you can't change right now. But for a lot of people, October and November are open enrollment season. And open enrollment is when you get to pick your new healthcare and dental and stuff for the new year at your job. And there's things that you can do right now for 2017 that could set you up for success when it comes to your taxes. So I want you to think about these 5 things to consider for 2017 when it comes to your taxes. First off, look at maximizing your 401k. So for most people, you can change your 401k throughout the year, but it's easier sometimes to plan it in advance. So if you're able to, look at maximizing that 401k contribution for 2017. Number 2, if you didn't qualify for an HSA this year, look at choosing a healthcare plan next year that has an HSA. Now that's a little scary for some because usually HSA healthcare plans are also what's known as high deductible healthcare plans. So they don't take very much out of your paycheck every month, but when you go to the doctor, you're going to pay much higher deductibles, and that can be scary for some people. So I'm not necessarily saying it's the right plan for you, but if you're looking for a way to minimize your taxes, the high deductible healthcare plan that has an HSA is a fantastic way to do it. If you do have that HSA, maximize it. So make sure that you are maximizing that HSA. And that's number 3. If you have it, maximize the HSA. Number 4, if you have children and your employer offers a dependent spending account, take advantage of it. So a dependent spending account or daycare flexible spending account, there's various terms that you use, but you can use pre-tax money to put it inside your dependent spending account, and then you can use that to pay for daycare or preschool costs or educational costs for your children. And I think the limit for 2016 and 2017 is $6,000 that you can contribute into this account. Every employer might have different limits, so check with your plan. But this is great because compared to the tax credit or the deduction, typically you will save twice as much in your taxes by taking advantage of the dependent spending account versus taking the tax credit on your taxes. So if you can take advantage of it, take advantage of the dependent spending account. And number 5, if you commute to work and your employer offers it, look at transportation spending accounts. So very similar. If some employers offer pre-tax money that can be used for commuting expenses, like if you have to buy a bus pass or a train pass, or you have to pay for parking at your job, you could use pre-tax money to put into the transportation spending account, and that will allow you to save on taxes each year. All right, guys, those are my tips. The 10 ways to save on taxes before the end of the year, and I gave you 5 bonus tips on things to consider for 2017. I really hope that you keep these in mind because for most of us, our number one expense is actually taxes. You might think it's housing or anything, but if you actually look at your tax bill, you're probably spending more in taxes than you are on any other expense in your life. So if you can do these things to minimize your tax burden, you're already saving money every single year. I hope you guys really enjoyed this video. Please subscribe to our channel. You can click the red subscribe link right next to this video, and I really appreciate it. And look for more from thecollegeinvestor.com. The full link to this article and all the links that we talked about and Everlance and all that is click the link right below in the description. It'll take you right to this article on the blog, and you can see exactly what we're talking about written out with all the limits and everything. Thank you guys very much, and I look forward to seeing you next week.